Good morning. Sorry, good afternoon. That's right, it's the afternoon already. So I guess it's 2 o'clock and we'll get started with the presentation. So hello again, and my name is Ann Schultz. I'm the CFO at the Workers' Compensation Board. And I'd like to welcome and congratulate those of you that have attended for coming today to learn about the enhancements that will be happening to our rate model. As well, I'd like to welcome the people that are attending online. So today we're going to be reviewing the changes to the rate model that will be happening in 2018 by showing you what would have happened had we implemented the rate model in 2017. So in 2017, you know your basic rates now. We're showing you what they would have been had we implemented the new model in 2018. So the presentation itself will take about an hour, and then we'll have a period for questions, and we will be also entertaining any questions that come via the webinar and the people attending online. If you do think of questions after today and after you've had a chance to absorb some of this information and perhaps review some of the other information we have online, there'll be opportunity for you to submit an email question to the Ask WCB email, and I'll provide you with that address at the end of the presentation, because there is a lot of information being presented today. You may need some time to just absorb it and think about it. So we are going to be talking about two rate codes today, and it's the automotive codes C61 and C62. So a little bit of an agenda. We're going to talk a bit about why the Wcb exists, the purpose of the rate model review, the impact of the changes that we will be implementing in 2018, and what the next steps are. So we have already shared some of this information at regional education sessions we did in fall. And we thought some of it had some really good information and just kind of lays the context about WCB, so we're sharing them again today. And I just wanted to remind you that those presentations, as well as the rate model review document prepared by the external actuary, is online, as well as other rate presentation sessions from previous years. Oops, went too fast. So, why do we pay WCB premiums? Prior to 1915, workers, if they were injured, had no recourse or no benefits available to them. So the only thing they could do in order to get compensation for their injuries and to pay their medical costs was to sue their employers. So often if injured workers did that, first of all, a lot of them didn't do it because it was expensive, and if they often weren't successful. So they would end up being a burden to the state or on Social Security programs. Also, if employers who were sued were found at fault and an award against them was made, it often was a huge financial cost for the employers, and many of them became bankrupt. In Canada, specifically in Ontario, around the beginning of the 1900s, the government recognized the problem of more and more people becoming reliant on Social Security to exist, because they were often hurt at work and had no means of supporting themselves or their families or paying their medical bills. So in Ontario, the government commissioned a study by I think his name was Sir William Meredith. And Sir William Meredith studied the whole issue of injury at work and insurance related to that. Sir Meredith crafted a workers' compensation model that he called the historic compromise. This compromise that workers would give up their right to sue in exchange for medical and wage loss benefits, and employers would assume the cost of the system in exchange for protection against legal action against them. All jurisdictions in Canada have adopted this model and created their own workers' compensation legislation. It's evolved over the years, but the principles that Meredith outlined back in the early 1900s exist today and have been adopted in the provincial legislations, both in Canada and across the world. So the Saskatchewan WCB legislation was enacted in 1929. So what's become known as the Meredith Principles, which guide workers' compensation plans, were based on principles. The first being that it is a no-fault compensation system, which means that workers are paid benefits regardless of how the injury occurred, and there is no argument over who caused the injury or liability for the injury. The second principle that's very important and important to our rate-making model is that there should be security of benefits. So this means that a fund needs to be established to guarantee funds to pay benefits for the current year and for as long as benefits will be related to that injury, which could go 50 years into the future. So the system has to have the ability to pay those benefits for long-term claims. The provincial legislation also reinforces this concept and requires that we be 100% funded at all times. The other aspect of Meredith Principles was the notion of collective liability, which means that covered employers, on the whole, share in the liability for workplace injury insurance. The total cost of the compensation system should be shared by all employers, and all employers should contribute to a common fund. Financial liability becomes a collective liability, and this is foundational to all insurance programs. So if you think, for example, of your house insurance, you get put into a risk pool based on the kind of house you have, whether you have a fireplace, a wood-burning stove, the location perhaps of your house, whether you're in a floodplain or not, and you're assigned to a risk pool and you share in the cost of insurance or the costs related to insurance claims for everyone in that risk pool. That's similar to the workers' compensation. We will get a little bit more into classification and risk pools throughout the presentation. The last two principles that Meredith outlined have to do with the administration of the plan. The first principle is that it should be an independent administration, which means that organizations who administer the workers' compensation insurance should be separate from government to avoid political interference in either determining benefits or in the rate-setting process. The last principle that Meredith outlined was that there is exclusive jurisdiction, which means that only workers' compensation organizations provide workers' compensation insurance, and all claims are directed solely to the Compensation Board. The board is the decision maker and the final authority for all claims. This principle supports the concept of collective liability for work injuries as well as security of benefits because it makes the system robust. So these principles all continue to be valid and support WCB compensation systems across the world. So this is a slide we've shown before at our rate setting presentations as well at the educational sessions that we did last fall, and basically goes through the steps involved in coming up with the rate that you finally end up with at the end of the day. So the first step is that industries are classified into 50 rate codes. So based on industry undertaking, it's like being assigned to a risk pool. You're assigned to a risk pool, that's the rate code you belong to. So that's the first step. So in the province, we have approximately 47,000 employers, and every one of those employers has been assigned to a risk pool of covered employers. The second step is that we base, after you've been classified into a risk pool, we determined the premium for that risk pool based on your previous or historical experience. So the collective experience of all the employers in an industry code determine the industry rate code. All employers in that rate code start off with the same base premium rate. So you're in the same risk pool, you pay the same rate. After we establish the industry code rate, we do the final step, which is the experience rating program. So this program considers individual experience, and depending on that experience, the employer will either be better or worse and could receive a discount or be charged a surcharge based on his experience. So this promotes fairness and accountability for injuries at the employer level. So within our experience rating program, we have, if you want to call them, 2 sub-programs. There is a standard program that applies to small employers with fewer than $21,000 in premiums over 3 years. This program assesses the penalties or provides discounts based on the frequency of injuries. So it's if an injury happens and there's progression with respect to the discounts and surcharges. The maximum discount is 25% and the maximum surcharge is 75%. In Saskatchewan, 88% of our employers are in the standard program. So 88% of our employers would be considered small because their premiums are less than $21,000 over 3 years. In the advanced program, the same $21,000 limit applies to premiums collected in a 3-year period. However, this program is different in that it is cost-based, and the cost for an individual employer is compared to the relative costs of his peers in his risk pool or rate code. And if you are better than your peers, you will get a discount. If you are worse, you will be assessed a surcharge. The maximum discount in the advanced program is 30%, while the maximum surcharge is 200% in the advanced pool, or the advanced program. So why did we need a rate model review? The rate model review was recommended in an asset liability study that the board undertook following the board's investment optimization study. So lots of big words there. So the asset liability study was basically a study where we had an actuary look at our investments that we use to partially fund the cost of future injuries, as well as the makeup of our liability and the payment streams coming out of that liability into the future. So they looked to see how well they are aligned. During the process of doing that, the actuary who was doing our asset liability study said, you really haven't looked at your rate model for a while. We recommend that you review your rate model just to ensure that it's still consistent with the principles that around collective liability, accountability, and reactivity, as well as stability of rates. The asset optimization study we had done basically looked at the pool of our investment assets, what returns they generate, and whether they're generating enough to meet our needs with respect to funding the assumption that we make in our benefit liability for those costs that may run out 50 years. So that's called the discount rate that we use to assess the value of the costs 50 years into the future. So we need to earn a certain rate of return to fund those long-term claims, and we build that assumption into our rate model. Again, this supports the Meredith principle of security of benefit. We have to make sure that we collect enough money to meet our current obligations as well as our obligations into the future. The other reason that we did the rate model review is that we have heard from some employer groups that our model was not reactive enough to improvements or changes in injury rates. So the board agreed that we should review the rate making model. Our rate making model was reviewed by the same actuary that did the asset liability study, Eckler. And in his study, he reinforced several guiding principles. And these are sometimes competing principles, so that's why they're shown on the scales of justice on the slide. So when you're accountable there's not a lot of collective liability. So accountability would mean that rate codes are totally responsible for all their costs. But that has to balance off with the concept of collective liability, which says that employers should not be unduly punished or responsible for unusual claims, and that kind of cost should be shared amongst all employers. So back to my house example. If you were to lose your house in a drastic event like a fire, you wouldn't be responsible to replace it all, right? Your insurance premium wouldn't jump to, hundreds of thousands of dollars the next year because you had that cost. And it's the same concept here. You're in a risk pool, and collective liability helps to absorb really unusual claim costs. So the rate model has to balance both of those things. The accountability for the experience that the employer should have versus how much of the risk for really unusual events gets shared amongst all employers. The other set of scales up there has to do with rate stability and reactivity. And this concept works with the accountability and collective liability as well. So with rate stabilities, we want to have rates that are predictable and not volatile. But we also want them to be reactive to changes in the economy, to changes in the injury rates, to changes that are happening in an employer's experience. Generally, the more accountable you are, the more reactive that rate is going to be. So those scales kind of work together too. So we have to balance all four of these principles when we look to developing the rate model. And the actuary actually used the concepts within these balancing principles when he reviewed our rate model. And we seek to, get to an appropriate balance of all four of these principles. So what was critical to the review process? WCB must continue to collect enough premiums in a fair and equitable manner that is transparent, because we need to provide security of benefits. We need to ensure that we have enough money to pay those claims that could last up to 50 years. The other thing is that today's employer should pay for the cost of today's injuries. So that is a fairness concept. And the model should follow actuarial standards. So actuarial standards are all about the science behind the statistics and the analysis we do with respect to ensuring that we have enough funds to cover off that future liability. And as well, the actuarial standards help with us determining what is reasonable and not excessive for any one rate code. So the rates model review had some overall key findings and then several key recommendations. These recommendations are, again, documented in the ECLR review document that is on our website. Basically, the actuary found that at the board level, so that's at the risk pooling level of all 50 rate codes, all of our rate codes, that the model works well and collects the required premiums. And that's evident by the fact that when we ran the old model versus the new model, the board average rate came out at $1.24 under both models. However, the actuary recommended that we look at several elements or refinements to the board's model to maintain the financial health of the WCB and the confidence of our ratepayers. So in the shift to the enhanced model, there are some bigger impacts in some industry code levels. So the key recommendations are up there, and we're going to be going through all of them in some detail, except for the classification recommendation. So before I talked about classification, that the 4,700 or 47,000 employers are grouped into rate codes. And ECLR said you've got a lot of really small rate codes. And the smaller the rate code, the less we're able to rely on that rate code's experience to predict out what their future experience is going to be. So, you know, with respect to that, we have 88% of our employers in the standard program. So there's a lot of employers that are in small rate codes. And the small sample size makes it harder to predict the future. So ECLR recommended that the board implement a process to periodically review classification. Currently, we have an ad hoc process, and we usually will only review classification upon request or if something points us to do it. So ECLR said you need to set up a process where you have some discipline in looking at your classification and do it on a regular basis. However, we don't have that process, and it takes time to develop that process. So the board has decided that we would not implement this at this time, that we will do some more analysis and more consultation with stakeholders like yourselves in order to come up with what that periodic process might look like. So right now, and in the near future, we'll continue with the current classification system. However, we will be using one of the enhancements that ECLR talked about, which is credibility, to deal with small rate code sizes. So now we'll get into the impacts comparing the 2017 old to new that will give you some idea of what might happen in 2018. So these are not your 2018 rates. We don't have the data to complete the 2018 rates. As of yet, we will be coming out with those in fall, and the 2018 rates will be based on the new model. What we're showing you today is a comparison of what would have happened had we implemented in 2017 to what we did have for rates in 2017 under the old model. So the first recommendation was around credibility of industries. So, as I said before, credibility of industries is related to the classification recommendation. Because we have small rate codes that are less credible, we're less able to predict with confidence the future costs for those rate codes. ECLR recommended changes to our current credibility process. So currently, we calculate credibility based on premiums paid. And in the current methodology, only 10 rate codes have credibility greater than 75%. Under the current methodology, if you're not a fully credible rate code, we use the experience of all other rate codes to supplement your experience in order to get some predictability with respect to costs going ahead. So I might slip in my terminology and use board level experience, but when I'm talking about board level experience, I'm really talking about the experience of all 50 rate codes. So right now, if you're not a credible rate code, we use the board level experience to supplement your experience so that we get some confidence when we're predicting your future costs. When we predict future costs, right now we base it on 5 years of experience, except for medical costs. Medical costs, we look at the last 3 years because in the last few years, medical inflation has been way higher than regular inflation. So what ECLR has recommended is that for rate codes that aren't fully credible, that their experience should be complemented with a longer period of their own experience and move away from relying on other rate code experience. So we won't be using board level or everybody else's experience to make your experience more predictable. We're going to be using your own experience by going back farther in time to calculate that average cost that we use to predict out to the future. And the other thing that ECLR said that we needed to change was not to look at premiums, but to look at costs. That costs should determine whether an industry code is credible or not. So the new model will be calculating credibility using claims costs over that 5-year period, inclusive of all costs, so medical and claims costs, or comp costs. So once a rate code reaches approximately $16 million in costs over 5 years, it would be considered to be fully credible. So if you recall, I said that under the current way we do it, only 10 rate codes have credibility over 75%, and even our largest rate code is not fully credible. In the new way of doing it, about half of the rate codes, 23, will be over 75% credible, and we have several rate codes that are considered credible enough to stand on their own. So if a rate code, say for example, has $10 million of cost over 5 years, 10 million is approximately, would result in about a 60% credibility calculation. So we would be using 60% of the 5 years, plus we would supplement that experience with 40% of their 10-year average to come up with an average to predict out to the future. But it's only based on that industry's experience, not everybody else's, like we used to do. I hope that example worked. So if you're calculated to be 60% credible, we use 60% of your 5-year average costs. If you're to make up the other piece to 100%, we have 40% based on your 10-year costs. So it's a proportional calculation to consider what your average cost would be in order to predict what the future is going to be. So doing it this way will result in the credibility part of the rate setting taking more into account an industry's own experience, therefore improving accountability and predictability. And the other thing it does, it helps balance more recent experience and reduce volatility for smaller rates, because they'll be looking over a larger time frame to calculate the average, therefore increasing the predictability of that average in calculating the future costs. So in general, rate codes negatively impacted by the credibility change are seeing an increase because their experience is worse than the board level experience, which decreases their costs under the current model, or their 10-year average costs are higher than the 5-year average cost, which would increase their costs under the enhanced model. Rate codes that are positively impacted by credibility are seeing a decrease because their experience would have been better than that board level experience that we used to average in, which increases their costs under the current model, and or their 10-year average costs are lower than the 5-year claim costs, which decrease their costs under the enhanced model. So for G61, the impact of the credibility element on the rate model for 2017 was estimated to be about 5 cents. G61 is currently 82% credible and has very similar experience to the overall board experience. So making that change had very little impact. Under the new enhanced model, G61 is 100% credible, so we'll be using 5-year costs. But if you recall, I mentioned that we used to use 3 years of medical costs in calculating the rate premium under the old model. With the enhanced model, we're using a 5-year average. And this has brought the medical costs down for this rate code, so that is why the decrease, because we're using medical costs averaged over a larger period, which brought the number down. For G62, we see kind of the opposite thing going on. So G62, automotive service, shops, and towing, the current credibility is 74%, but G62's experience is worse than the overall board experience, so that's pulling up their costs. And under the enhanced model, they'll be 100% credible. And the same thing is happening with medical costs. but kind of in reverse. So going to the 5-year average for medical costs increased the costs. So the net impact for G62 is a 9-cent increase for that element of the model. The other recommendation that Eckler focused on during the rate model review is that the current model uses injury rates and time loss counts to predict what future costs would be. When the model was established back in the 1990s, this was valid. However, with the emergence of new trends such as return to work, the medical cost increases we've seen, and significant reductions in injury rates and time loss counts, it's no longer valid for predicting future costs. So as a result, but through backward testing, we discovered that time loss counts no longer correlate well with costs and the increasing cost per claim that we've been seeing in recent years. Eckler said, use your costs either based on the 5 or the combination of 5 and 10-year costs, depending on credibility, and use the change in workforce to predict what the future costs might be. The change in workforce is an estimate of the change in the number of insured workers in the rate code. This change in workforce is very strongly correlated to the way costs have moved over the last few years. Because we knew that our model was underestimating costs based on the time loss counts, our injury rate, the injury rate was going like that, the costs were going like that. We had intervened in the model to reduce the volatility that created by blending 2 years of rates to ensure that the increasing costs of claims were covered by the premiums and to reduce volatility. So what that means, in your 2017 rate, it's actually a blend of your 2017 and 2016 rates. Eckler said we should discontinue that practice and more focus on costs and the change in costs as evident, or estimate the change in costs based on the change in workforce. So the impact on C61 Automotive and Implement sales has been an increase of 2 cents. The removal of the rate averaging to make it more reactive increased by 9 cents, but the current model blending thing that we were doing, that reduced it by 7 cents, so the net increase was 2 cents. So for C61, this change of indicators will result in a 2 cent increase for that element of the model. For C62, the opposite happened. So the removal of the rate averaging and the adoption of the workforce application to cost resulted in a 5 cent decrease to C62's premium rates. Using the workforce caused the rate model to expect increases in claims liability costs or future costs with about 5 cents, where removing the blending caused the rate to go down 10 cents, so the net of that was 5 cents. The next element of the model that Eckler looked at was costly claim pooling. So costly claim pooling is, in the current model, is when we share costs over certain limits amongst the class of employers. So for example, we have kind of 3 levels or 3 tiers of employer groupings. So there's the overall board level, which includes all employers, all rate codes. Underneath that, we have 10 classes, which kind of groups similar rate codes. And then underneath the classes, there are 50 rate codes. So in the way we currently do costly claim pooling, we only look at pension costs. We do not look at comprehensive costs related to a claim. So we only cap pension costs in excess of $90,000, but we share that, the amounts over the $90,000 get shared at the class level. So there are, I believe, 7 rate codes in the C class. Those pension costs are treated like collective liability at the class level for those 7 rate codes. Eckler said you shouldn't be doing that. You should be pooling those costs at the board level amongst all employers. The other recommendation was that Eckler said you really need to, when you look at the cost of the claim, it's not just pension, it's medical, it's comp, it's everything. So he said you need to look at all of the costs related to a claim and apply a cap to all costs. He also recommended that we pick a cap that moved with inflationary pressures, and recommended that we look to pegging it to the maximum insurable earnings. So after some analysis, Eckler didn't really tell us what level of maximum insurable earnings we should peg our cap at, but doing some analysis, we discovered that 3 times the max, or about $251,000, seemed like a good amount to set our cap at, because most rate codes, 40 out of 50 rate codes, would benefit from that, whereas if we had used, say, for example, 5 times the max, only 11 rate codes would benefit from having that cap at 5 times, which would have been twice that, almost twice that, $251,000. So the changes to this element of the rate code really improve 2 things, and it's the scales of justice again. Accountability, so employers are going to be held accountable for claim costs up to $251,000. However, they're going to have some collective liability because costs in excess of that $251,000 will be shared at the board level amongst all employers. For the costs that go into that board level pool, they will be allocated back to the industry codes based on the proportionate share of cost in that rate code as compared to all rate codes. So it's a collective liability way of sharing the costs. I'll be talking about fatalities in a minute, but fatalities will also be included in this capping. So fatalities can have, quite a wide range of cost, but if a fatality is greater than $251,000, it would also be pooled at the board level, but we'll get into that in a little bit more detail. So the impact on the auto and implement sales rate code was a net decrease of 4 cents. And that occurred because the average pension costs are lower than the average Sector C pension costs, and pension pooling used to actually increase C61's rate code. However, on the other side of that, that's been offset by a larger decrease because costs in excess of the 3 times max are higher than the board average. So there's more costs in this rate code above the $251,000, therefore it's going into the bigger pool, and this rate code is benefiting from that, from the collective liability. The impact on C62 is kind of washes out to nothing with respect to the change on the cost of claim pooling. So while the average pension costs are higher in C62, and they used to benefit from the pension claim pooling, their costs in excess of the max are also higher. So the benefit that you got before under the pension pooling is being offset by the fact that you do have costs in excess of the max, which are adding to your costs. So that washes out to a nil impact in 2017. So now we'll talk about the changes that Eckler recommended and the board approved with respect to fatality costs. So fatalities currently are charged to every rate code and every employer on the same basis. So we take the 10-year average cost of all fatalities, and we come up with an average cost per payroll. and that works out to 4 cents for 2017. So all rate codes are charged that whether they had a fatality or not, and that's what happened in 2017. Eckler recommended that we really needed to look at increasing the accountability with respect to fatalities, and that we needed to charge fatalities to the industry in which they occurred. He recommended that we do it on either an actual or an average cost basis. After consideration, the board decided that we should treat fatalities like any other claim. So all costs related to fatalities will be treated just like any other claim, subject to that capping of the $251,000. Fatality costs can vary. They can be as low as $10,000 for someone who had no dependents, and they could be as high as $1.6 million for someone who had a spouse and, say, 2 or 3 kids. So this recommendation provides for more accountability, but it also has an element of collective liability, in that excessive costs are going to be borne now by all rate codes through the pooling of the costs in excess of $251,000. So maybe I'll just slip to the slide. The impact on C61 is a net decrease of 2 cents. There was 2 fatalities in the years 2011 to 2015, which go into the determination of the average costs moving ahead. And because of the change, there's been a 2 cent, there would have been a 2 cent decrease in 2017 had we implemented the model in 2017. So the costs are less than the 10-year average that you would have been charged. In C62, the change for fatalities is negligible. It works out, it's less than a penny decrease. There were 2 fatalities in 2011 and 2015, but because of the cost structure of those fatalities, it pretty well washed out. They would have cost that rate code 4 cents anyway. The other thing that Eckler looked at was long-term claim costs. So when I talked about credibility, I talked about that we use 5 and 10 years, depending on the credibility of the industry, in order to predict future costs. Within the costs you experience in that 5-year or 10-year average, or combination of the two, there could be costs in there that are 30 or 40 or even 50 years old for injuries that happened way in the past. So those costs under the current model were still included in that average in order to predict the future. Eckler said that that's not a good practice because a lot of things have changed. Those were previous employers. The economy was different, the jobs were different, safety and prevention was different. So to include those costs to try to estimate what's happening in the future didn't make sense. So he recommended that we look at a way or an appropriate number of years to cut off those cost claims. So he had recommended, I think, between 5 and 10 years that we should look at dropping off those old claims when we charge them to an industry code. After analysis that we did at the board, we determined that 7 years was a good cutoff, because at 7 years, if you include 7 years of experience, approximately 75% of the costs are accounted for in that 7 years, and 25% would fall out of that 7 years. So with this recommendation, within that 5-year or 10-year averaging period, we're going to cut off costs that are more than 7 years old. And those costs will also be pooled again at the board level or all industry level and be reallocated out based on the rate code's cost. So old claims will no longer be impacting our estimation of what's going to happen in the future. And this change will, it promotes reactivity, fairness, and accountability. And also reactivity to more recent experience. So in C61, the impact on the rate code would be an increase of 2 cents for this element. C61 has a smaller portion of cost in the long term than average, so pooling those costs increases their cost. So there's less costs in that greater than 40-year-old range, but they're still going to be picking up a share of that pooled cost from every other rate code. C62 again has a smaller portion of costs in the long term than average, and pooling those costs increased their costs, but not enough to impact the rate. So it was pretty well a flat impact. The last element of the rate that ECLR reviewed and made recommendations on was how we allocate our administration costs. So these are the administration costs of running the board, and we have fixed costs as well as variable costs. So fixed costs, the costs that we're going to incur whether we're doing business or not, and the variable costs kind of move with your business activity. With respect to the WCB, our fixed costs would include costs incurred whether a claim happens or not. So, for example, would be the salaries of the executive and the board, our IT systems, employer services, because whether a claim happens or not, you still have to register, you still have to get clearance certificates, so forth. Variable costs are costs that are related to managing the claim. So these would be mostly the salaries and benefits of the people involved in administering claims. ECLR said it's good that we currently do have, we allocate administration costs based on both fixed and variable, but he thought, based on what he's seen in other boards, that our ratio of 90% variable to 10% fixed was out of whack. And he recommended that we actually go back and have a look at our cost structure and see where the costs, are they fixed or are they variable related to claims activity? So we went back and did that. We actually found that the fixed component has increased to 30%, where it used to be 10%. So we've changed how we allocate these costs at the board level. 30% will now be on fixed and 70% will be on variable. So the impact of this is that industries with lower premium rates and supposedly lower costs will likely see an increase to their administrative component of the rate because they're picking up more of those fixed costs. And industries with higher premium rates will see a decrease because they're going to be picking up less of the variable cost because we're moving from 90% to 70% for that allocation. So the impact on C61 has been a 1 cent increase. And again, that 1 cent is just falling out of, there was a decrease. They went from 90 to 70% on the variable, which dropped the allocation by 6 cents. But they also had a 7 cent increase because of the change in the fixed component from 10 to 30%. So it nets out to a 1 cent increase. C62, on the other hand, is seeing a 3 cent drop. And that is because they are a higher costing, they have a higher cost base in their rate code. So their variable portion dropped by 10 cents, and they also went up by 7 cents on the fixed for a net out of 3 cent drop. So if you look at these slides, it's showing the impact of all of the elements together. So all of these elements work together. So the fatalities work with the claims capping, credibility works with changing of indicators, cost of claim pooling, and fatalities. So it all works together in terms of the elements coming together to help us predict what the future costs will be. And it sounds kind of harsh, but you can't cherry pick which elements you like and which you don't, because they do work together and they are integrated. So this is a package. So the numbers that we're showing you here are meant to help explain what would have happened had we implemented the new model in 2017, and perhaps give you a heads up to what will happen in 2018. What happens in 2018 will be dependent on your 2016 experience, as well as and how that compares to that year that's dropping off, the 2011 year, when we calculate the 5-year average to predict future costs. So the net impact on C61, had we implemented in 2017, would have been a 6-cent reduction, or a 5.3% reduction in the rate. So for the rate code as a whole, that translates to about $633,000. And for the 1,086 employers in that rate code, it'll be would have been a decrease of $583. For C62 automotive sales, shops, and towing, the impact of all of those elements has resulted in a 1 cent increase, less than a percent increase in the rate from $1.78 to $1.79. The total dollar impact for the rate code is about $42,000, and when you divide that by the 1,400 employers, works out to about an increase of $29 per employer. So these impacts are on the transition only. Moving ahead, it'll be your own experience which would dictate where your rate goes. So our next steps. So today's presentation will be recorded, or is being recorded right now, and will be available on our website. If you have additional questions that you don't think of today and would like to send in, you could send them in to the Ask WCB email address. And the other thing that we really are begging for, and I'm speaking on behalf of the board, is input with respect to how we should transition this model. So we have a form on that website which outlines a couple of options of how we move to this new model. So one option could be we just adopt in 1 year, like bite the bullet and do it. The other option is we do it over 2 years. So that means those getting an increase would see that increase spread out over 2 years. But conversely, we still have to collect the same amount of money. So those getting a decrease would also see their decrease phase in over 2 years. Or what other options might be available, for example, capping decreases or increases. So we really encourage you to provide that feedback on that form, and that's the only way we will be collecting the feedback. So overall, we need to collect the same revenue, but we have to transition. The board has decided to move to this model. We are moving, it's just how we move, and we're asking for that feedback from you. So we will open it up for questions now. Please go to the mic if you have a question, and we'll also, if there's any questions that come from the people attending online, they'll be brought up. Thank you very much for attending, and I always forget to do this slide. In closing, I would just like to remind you that the importance of injury prevention and reducing costs. The least expensive claim is the claim that never happens. Our ultimate goal of Mission Zero is still in place. 88% of employers in 2016 were injury-free. And again, I would like to thank you for your efforts, because it is your efforts that are resulting in us getting closer to Mission Zero. And I would like to thank you for your time in attending today. So we'll open it up for questions. There's some, I believe, some sheets on the table. If you want to make some notes to take away, or if you have some questions you'd like to submit later, please do so, and we'll try to get back to you as soon as we can, if there are things that you just aren't coming to you right now.
Has the board ever thought of making the employees pay a small fee to contribute into the insurance policy? And would that not have a deterrent for them to do better as well?
So that would violate the historic compromise. So, and as far as I know, I don't think our board has considered that. Oh, sorry. So the question was, has the board ever considered charging employees a small fee to help pay for this insurance? So the answer would be no. That would violate the historic compromise, and as well, I think would be against our legislation. We cannot charge employees for this insurance. By legislation, employers pay WCB premiums.
Hi, I'm Mel Barber. I represent business in the automotive field. And I'm speaking more from a personal point of view, maybe, and I'm not speaking for other dealers. I'm speaking for myself. How flexible is the board if the government decides to change the system from an adversarial position to a collaborative position that's transparent as far as the employees are concerned? The employees go into they're the weak link in the three people that are involved in the system, the WCB, the employer, and the worker. And presently the workers go into the system not knowing very little, and sometimes the system is seen as deny, because that request has to go back before they're given what they probably deserved in the first place. And whether that's because of a lack of training or something else, I wouldn't want to generalize on that statement, but I have seen it happen. So if the government wanted you to become more collaborative, it's going to cost more money. Are you able to adjust this quickly to meet their demand and the employer's demands if we request more out of WCB, so our employees are treated in a more satisfactory way with the system? You know, I went to the annual meeting and I was a little bit disappointed in the people there. They were all looking for money kickbacks because we've either been charged too much or the worker has been paid enough. And I was disappointed that no one in that meeting of one day, at least, if not 2 days, came up with the question, are our workers being treated fairly? And I was disappointed that that was never addressed. So I guess I just want to know how flexible you are if you're given instructions by employers and the government that we need to charge more to the employers to treat our employees better when they're hurt. Thank you.
Yeah, I think what you're asking is with respect to the benefits that would be paid to an injured worker. So again, that's a legislative thing, and we would accommodate that in our rate setting model and our estimation of the cost, like we have with the increased max. That was an increased benefit that was brought in December 1st of 2014. So that's one example I can think of where we have reacted to improvements for benefits for injured workers. And I don't know a lot about the psychological claim stuff, but there's been new legislation with respect to that, which has a presumptive clause for psychological injuries, which I think is a benefit for injured workers as well. Is there anything online? Well, if that's it, I'm sure you would all like to get back to work. So would I. So if you do think of any questions in the future, please refer to that last page of the presentation, and there is a website or an email address where you can submit your questions and we will return them as soon as we can. And this session will be available for future viewing pleasure, if you like. Thank you very much for coming out.